Hello, my name is Will Farrant. I'm the chair of the National Committee of the Australian Securitisation Forum. Welcome to what is the first of a series of podcasts that we will be conducting with market participants from around the world to give insights on global securitisation markets as well as our local market here in Australia and New Zealand. For the first of these, I'm very pleased to be joined by Alexander Batchvarov from Bank of America, and we're going to be talking about global events. Welcome, Alexander. Thank you. Welcome to Australia, and thank you very much for spending some time with us at the Australian Securitisation Forum, talking to us about what you see in your trips around the world and your day-to-day life. And perhaps to intro that, you could just give us a bit of a feel for what your role is, what markets you look at, and where you fit into the Bank of America.
Thank you. Pleasure to be here. This is part of my annual homage to Australia. I come to Australia once a year ever since 1998. So I can say I started coming here in last century. My responsibility at Bank of America, formerly Merrill Lynch, were and still are head of international structured finance research. So I follow, technically speaking, in detail all markets, all securitization markets outside US and Canada. But for some reason, I have to also keep an eye on the US simply because investors are global, increasingly global. So you need to know what's going on in the different markets before you can come up with proper recommendations. My stop in Australia is after visiting Dubai, Japan, and New Zealand. And I have two more stops before I get back to London. So I'll probably stop in Singapore and maybe one more time in Dubai. This is natural stops where the investor base is focused. And the investors in these countries are predominantly focused on Australia, global CLOs, both Europe and US, and other high-yielding products.
Right. Well, 1998, in this market, that was at the very early days of the Australian market, a little bit more advanced in some of the offshore jurisdictions. So that's several market cycles that you've been performing this role through. So maybe if we just take a macro view to start with, cycles are often driven by capital flows. And at the moment, certainly for a lot of us sitting here in Australia, we feel like there's a lot of capital coming into the market at the moment. Yep. Perhaps you could share your observations on those capital flows, maybe sort of where they're coming from globally, and as they're washing up into Australia and New Zealand now, the impact you think that could have on our market.
Yes. When we are looking at the markets today, I think we have to incorporate two different angles. One is cyclical flows based on monetary policy, relative value, and so on, which is probably the normal flow. And also now we have to look at geopolitics and other more radical fundamental changes in the market. So in the last 6-9 months, I would say we're experiencing serious changes in geopolitics, be it whether you're looking at tariffs in the US, defense spending or desire to do that, Middle Eastern problems, China-US rivalry, and so on. So these are exacerbating or changing the direction of flows. And parallel with that, we have a little bit of a long-term trend, which is private credit. That's post GFC, post the heavier regulation and capital demands on banks. We have seen significant increase in the private credit activity, first in the US and Europe, and then increasingly in Asia. So when we are looking at the flows, we have to keep in mind this broader and near-term changes. So the trend to de-dollarization is certainly there. That is benefiting the so-called peripheral dollar, that is Canada and Australia. So part of the growth of demand and flows into Australia is coming from that. Number two, given the uncertainties, geopolitical, trade, and other, we are seeing more and more investors looking into diversification to the maximal possible degree, which basically means you have to go into Asia, you have to go to Middle East, you have to go to Africa. The third related issue is the availability of investments. I think that we had crisis in China with the real estate companies. We have generally shrinkage of the IG market, corporate market in APAC. And in this way, Australia is stepping in. We are seeing more issuance from Australia, both at the sovereign and corporate bank sector. And we are seeing more kangaroo issuance in Australia. So that is, in a way, creating a broader fixed income market for Australia. I would say it's probably one of the largest fixed income markets in the world, probably number 4 or 5, depending on how you count China or India domestic. And that, in a way, is creating the background for interest also in the securitization market. So the flows, in my view, have more permanent character through de-dollarization and interest in a much bigger and growing fixed income market, and a more tactical dimension, which is monetary policy, spread compression, demand for yield following the rate cuts. And I think that there'll be another monetary policy angle to that, which is the terminal rate. If Australian terminal rate is with a free handle, as expected, I'm not going to go into whether 3.25, 3.5, and the European terminal rate is probably with a handle of 1, at best 2, but more likely to be in the 1.5, 1.75 range. We're looking at very different relative value and very different yield for the structured products. I mentioned monetary policy. Historically, when we have rate cuts, we are seeing investors rolling out of floaters and into fixed rate. I need to emphasize that Australian market, European market are predominantly floaters for structured finance, where in the US it's mostly CLOs and a little bit of consumer credit cards. The rest of the market is fixed. So the rolling out of floaters into fixed is one of the ideas or natural reaction to a rate cut cycle. I don't think we're going to see it to anywhere similar degree in this rate cut cycle, simply because of the geopolitical aspects I mentioned, and also because of the terminal rate expectation and discrepancy in that in those levels.
Right. So, well, a couple of questions from there. On the terminal rate, that differential between where Australia might end up in the 3s and other jurisdictions in lower interest rate terminal rates, do you see that as an influence on capital flowing in as partially an FX trade, expecting a stronger Aussie dollar? And if that's the case, are AAA ABS securities, for example, a way of like making that play for international money managers?
Potentially, yes. Although it's an interesting dynamic. Let me just contrast the current state of the Australian buyer base relative to, let's say, pre-GFC. If you look at the Australian securitization market today versus pre-GFC, even if we say that the issuance volume last year was pretty much similar to the one pre-GFC, we had a very different currency composition of the issuance. So pre-GFC, the majority of issuance, 70, 75%, maybe even 80, was in euro and US dollars. A significant portion was 144A format. And the investor base was buying balance guaranteed swap transactions, RMBS predominantly at that time. Today, it appears that the majority of the investor base is happy to buy directly Aussie dollar exposure. And I think last year only 2 or 3% of the issuance was in another currency. Now, a related question is whether investors hedge themselves or not. And I have the impression that the hedging is either on a very macro level for the group that is buying ABS, not the specific portfolio or specific bond, or maybe there is no hedging at all, which is probably a bet on direction of FX. And in that regard, there are probably buyers who are betting on the appreciation of the Australian dollar. However, I think that these days geopolitics and fiscal over monetary policy may be the one which is driving perceptions or expectation for FX. We have situations with zero rates and very strong currency, and situation where raising rates are actually undermining the currency strength. So the geopolitical factors are probably now overwhelming some of the historical dependencies and correlations when it comes to rates. But my view is that investors are now looking to diversify, not only by product, but also by currency. We're seeing shifts in the sovereign reserves in terms of composition, more currencies, more gold, relative to heavy weight into US dollars, as was the case in the past. And all these factors are really influencing investor decisions or expectations for currency and hedging.
And going back slightly to one of your earlier comments as well, we are seeing more capital coming into the Australian markets for some of the reasons that you mentioned. It feels that globally there is more capital chasing assets, particularly within securitized and similar markets. Is that a function of people reawakening to the benefits of securitized products? Or is that just a function of how much capital there is and perhaps how much leverage there is in the system?
I would say both. On one side, there is more capital available looking for adequate yield or for reward. And that is partially driven by the significant growth in private credit. The expectation is that growth is going to continue, and it will probably affect both ABS investments and asset-backed finance, direct lending, which potentially is subject to securitization. We're looking now at opportunities or interest in CFO, collateralized fund obligations, subscription line financing, and so on. So this is one angle to it. The second angle is interest in ABS. So if you take back the market to 2010, there was a big scare based on what happened during the global financial crisis. But if you differentiate between what really happened, we had credit risk predominantly associated with U.S. Structured product, U.S. subprime mortgages, and we had market risk and mark-to-market risk associated with pretty much all the other products. That was not adequately, in my view, differentiated across the political and the regulatory community, and we ended up with very tight regulatory framework for securitization. I often give this example that in Europe, very often, the AAA, AA tranche of securitization have higher regulatory capital than the underlying, which doesn't make necessarily sense, especially when we look at the performance of Australian and European securitization product during and post GFC in terms of credit risk and losses, which are almost non-existent. The second thing I also highlight is that the way the regulation was structured, particularly in Europe, you need to do much more work to buy a AAA ABS and prove the due diligence, even if it's 2-year prime auto collateral, then you need to do in order to buy a 20-year non-performing loan portfolio or a 30-year commercial real estate portfolio. This doesn't make sense. So that regulatory framework created additional stress on the investor base, and I'm often facing board meetings in Europe explaining to boards of different institutional investors what really happened and why we have this regulation but very different performance. And it took a decade or more for investors to start realizing that. And we are now seeing more interest in the product. Gradually, the old kind of stigma or old views are falling away and making room for investments in the product. And then if you look at the last 5-10 years, or during the pandemic specifically and post-pandemic, the ABS products have delivered fantastic performance. If you just take CLO, for which we have a lot of data and indices and everything, you can see that they have outperformed corporate credit to a large degree. And then we went even further. We did a little bit of analysis on the performance CLO equity relative to PE funds. And one thing that we discovered in the analysis that very often the PE fund performance is back-ended. The returns are back-ended, where for the majority part, the CLO equity returns are front-ended. So you may end up in a situation where you're actually mixing the two could give you a very smooth returns over a horizon, which you don't necessarily realize in one or the other separately. So all this kind of analysis and research, and I shouldn't forget much improved liquidity, secondary market activity of the securitization market, both in Europe and US, and more recently in Australia, all creating the interest of investors to come back to that market.
That's an interesting point on the secondary market liquidity, because corporate bonds still rating for rating price inside of ABS generally around the world. Yes. Often that's put down to a liquidity premium. And it's often said, well, liquidity is great in ABS until you need it, and then it's non-existent. By your comments, it seems like you're seeing more liquidity coming in on the secondary market side globally. And do you see that in Australia as well?
Absolutely. So when people refer to corporate bonds, to covered bonds, one of the elements is often forgotten is that there are indices associated with this product. And when you have index funds and they have to invest, then you have a captive investor base. And they're looking to outperform with other instruments. And very often the other instrument to outperform is ABS or CLO or CMBS for that matter. But we have seen significant improvement in the liquidity of the product. It is expressed in what we call the B-week volume. We're tracking the B-weeks, and the B-week is only part of the secondary market liquidity, because in addition to the B-week, there is bilateral trading, which we cannot capture for lack of information or public disclosure. That is available in the US, but not necessarily available in Europe or Australia. So we are looking at those volumes. And to give you a very simple example, we concluded that during the pandemic and some of the crisis periods, the turnover ratio of the most traded products, which is in Europe would be the UK non-conforming buy-to-let product and Euro CLOs in the Eurozone, we're looking at turnover ratios somewhere to the tune of 5 to 10%. I think that's a pretty substantial turnover ratio, which we don't see in many other products. If we add the private bilateral trading, the volume would probably be bigger. So I do not have these numbers, and I haven't been able to determine these numbers for other sectors. But in recent years, there have been several detailed research papers published on the liquidity of RMBS, ABS in Europe relative to covered bonds on corporates. And the one thing that is proven very forcefully in this analysis is that, number one, we have significant improvement in ABS, RMBS liquidity over the last 10, 15 years. And in the last cycle, we have better liquidity in RMBS, STS, RMBS, ABS in Europe than we have in covered bonds and corporates. So the liquidity is relatively subjective assessment. Now, one way to test the liquidity is during stress periods. And I think we had two, which would kind of prove the point of improvement of liquidity in the product. One was during the mini budget crisis in the UK. We're talking here September, October 2022. And that tested both liquidity for European products, predominantly AAA, AA CLOs, prime RMBS, non-conforming RMBS, and for Australian product. During that period of 2 to 3 weeks, we had significant liquidation of all of these different products. And I happened to be there, actually happened to be in Sydney in October 2022. And we saw more than 1.7 billion trading on the market without material widening of spreads and significant spread compression within about a month. And when I say without material widening, we have to put it in perspective. We have to compare spread widening in corporates and gilts relative to RMBS or ABS, and we also have to compare what really traded. And one of the conclusions from the pension fund debacle in the UK was that actually pension funds sold the product they could sell without material loss in price. So for me, that's a very good example of the resilience on the secondary market and the ability to trade the product. The other example was during the after Liberation Day. So we are talking here April, May. We recently did an analysis where we look at corporate spread behavior in Europe from March to May 2025. And for the same period, March to May, for ABS, RMBS in Europe. So what we discovered was that the spread behavior in terms of widening magnitude of movement was more or less similar for investment grade tranches relative to IG corporates. It was bigger movement for sub-IG tranches relative to sub-IG corporates, but the recovery on the latter was faster. So from that perspective, we are seeing improvements in liquidity, and that is probably to be expected both with the volume of the market and the investor base. We have seen significant increase in the number of investors of European CLOs and significant increase in the number of investors of Australian ABS, RMBS. So from that perspective, I think we're on the right track. Whether regulators, policymakers choose to make that assessment and choose to take it into consideration remains to be seen, but the facts cannot be overlooked.
Yeah, and that premium maybe continues to be chipped away at between corporates and ABS. So let's turn for a second to innovation in the market. You talked before about private credit coming into the market to a degree. US-style retirement insurance products putting a lot of capital into the global market. You're seeing a rise of CFOs, fund finance, more SRTs of different products. So there's new products coming online. Two questions, really. The first is, how much do you see that as a result of a change in the regulatory landscape and sort of an acceptance by regulators or a recognition by regulators that actually securitization can grease the wheels of the economy in quite a helpful way, versus just pure yield-hungry capital coming into the market, which can generate that sort of level of innovation? And then secondly, are there innovations you're seeing around the world that you would expect to roll into the Australian, New Zealand market at some point in the future?
The entire growth of private credit is triggered by the tightening of regulation on the banking sector, and also in change in the regulations in insurers, which favored alternative investments. So we cannot deny that. It's a fact, and the market is probably going to continue to grow. We have potentially two dimensions that we need to talk about in terms of innovation. One is related to private credit and the growth in private credit, asset-based finance. How much of that is really visible? I'm sure there are new products created, but for us it's very difficult to see them and assess them because they're not public. On the flip side, we're seeing private credit getting into non-bank finance institutions, and we are seeing private credit getting more active into insurance world. So if we look into these two dimensions, Australia is a prime example with the offloading of auto finance from the banks into the non-bank finance companies, many of them actually funded by private equity and private credit, and the accelerated issuance as a result. That is certainly helping both the economy and the capital markets. And we have seen probably, if I'm not mistaken, auto ABS in Australia now is 2.5, maybe 3 times more than it was pre-GFC. And that's a result of the last 3-4 years. With regards to participation of private credit in insurance world, we are seeing materially different composition of the portfolios of the assets under management of the PE-sponsored insurers versus, let's call them, traditional insurers. We're seeing that both in Europe and the US. And when I compare the portfolio of a PE-sponsored insurer relative to the traditional one, we see a much bigger weight of ABS in those portfolios. We see a bigger barbelling of the portfolio between highly liquid and shorter-term instruments versus more structured, longer-term ABS exposures, almost no direct mortgage exposure, and more MBS exposure. This is visible in Europe and the US. I'm personally not familiar with the insurance market in Asia Pacific and Australia, where there is this kind of development, but it actually highlights, on one hand, the need for more securitization for this non-bank finance institutions, and on the flip side, the availability of buyer for this kind of instruments. Now, is there recognition of the role of securitization in the economy? Absolutely. Is there enough being done to increase that role and unshackle securitization from the heavy regulatory burden that was imposed on it post-GFC? Very slowly and I think unconvincingly. So if you take Europe as example, we had 3 major papers published, very authoritative, very well researched. One was the Draghi report on competitiveness of Europe, the other was the Letta report, and the third one was the Noea report. All these 3 reports emphasize the role of securitization in the development of capital markets in Europe and increasing the bank asset velocity and implementation of capital, of improving the investment choices for both retail and institutional investors. All this is heavily well documented and justified in the reports. So that gave a political momentum for change of the European securitization framework. Will that change happen, and would that lead to material improvement of the state of the European securitization market, EU versus UK? It remains to be seen. And we can certainly talk more about the regulations at a later stage, but I'm a bit skeptical about not the direction of change, but the speed and magnitude of change. So this is probably how the markets are going to develop. In Australia, we can say that Australia is leading in terms of non-bank financial institutions and lending and private sector participation. I understand there is more activity in Australia related to unitranche loans in the space of leverage finance. I don't think we have yet a BSL, broadly syndicated loan market, to the same degree. It's probably more club syndication, but maybe that is going to develop with the need. And in Europe, I would say Europe is more advanced in terms of BSL and direct lending, but probably more subdued in terms of non-bank financial institutions and lending. Banks are still the dominant lender in most of the Eurozone, in all of the Eurozone, with more active participation of non-banks in the UK. And that's why I emphasize the differentiation between UK and the EU, and now we'll have probably regulatory differentiation in the future. So the potential there is huge. And one aspect which I think is not fully explored, and we will remain to see how it is developing, is the financing of 3 priorities for the economies. One is the digitalization, the transition to new digital AI and so on economy, which is absolutely important if we have to improve productivity, which has been actually lagging and stagnating both in Europe and Australia for the last 10, 15 years. That would probably help deal with the demographic issues more in Europe than Australia. Australia, the immigration is helping with the demographic composition. And the other transition towards more environmentally friendly economy, more climate resilient and environmentally resilient economy, supporting of biodiversity, and so on. So securitization can play a role in both. By the way, the third element is defense, but it's probably yet unclear what defense spending we're going to have and how it's going to be financed. But securitization can play a role in all these dimensions. But here are some of the challenges we're facing. One, in order to open financing by banks for these new sectors, because many of these new sectors will have a construction period which securitization cannot really finance. Private sector, private capital could, and ultimately the exit would be securitization. But in order for the banks to do more of that, we need to free their balance sheet and free their capital. And securitization of existing assets is probably the most reasonable way to approach it. Second is environmental, but we need to build up that. Solar panels, they can be financed in the US, but we have very little of that in other parts of the world except China. EVs, the same thing. We need to have more penetration before we can get more EV pools. And with regards to defense, we have to really make sure that it is also considered part of environmental ESG compliant rather than currently being excluded in many cases. So securitization can provide that, but first we have to unshackle securitization from the current strict regulatory regime, or let's put it differently. We have to make the regulatory regime much more risk sensitive than it currently is, and then allow for the banks and the private capital to use that market for funding, for risk transfer, for line management, credit line management, and so on.
All of which points to there being lots of opportunity for innovation and growth in the sector as we go forward. We already touched on the fact that there's lots of capital available to fund that, looking for assets around the world. So as you look forward globally around the world in terms of this market, thinking really the public bond market side of securitization, what is your outlook? Are you bullish with those tailwinds in terms of volume, maybe spreads, depending on which side of the ledger, issuer or investor that you may be? Do we see growth there, or are we also seeing risks building up in the system that potentially tempers some of that growth?
So we are generally positive on the growth because we see the need and we see the opportunity. It's not being materialized fully, in my view. But again, I want to emphasize the differential between public and private. We see the public markets, but we don't see very much what's going on in the private market. So if we get a glimpse at that, it suffices to take a look at the UK and the EU SRT in synthetic format. So we are seeing growth in that market, but it's very difficult to ascertain in terms of magnitude, speed, asset classes, and so on, because the disclosure is not really readily available. And here's a very interesting parallel again with pre-GFC. In Europe, contrary to public perception, there was a well-developed synthetic securitization market prior to 2007. And a lot of that market was rated, is tranched, and part of it was traded. Right now, we have the exact opposite. We have non-rated, non-publicly disclosed, and non-traded synthetic securitization market in Europe. I'm not sure which one is better. But that's one example about a volume of securitization that we cannot track, and we don't know how it is growing. The second aspect is we're seeing a lot of portfolio disposals from banks exiting specific lines of business, which go into private credit funds. And we don't know whether that will end up in securitization or the fund itself will be issuing debt, which one can argue is quasi-securitization. The third development we're seeing is the ability to attract retail investors. And in the cases of US, this is the growth of the ETF. They're both acceptable and used by both retail and institutional investors. In Europe, the CLO ETF market is not available to retail investors. It's only institutional, but on the other hand, it's rather small to really make a difference. But that brings another very interesting question. You talked about availability of capital and liquidity, but one area of capital which can help the economy, or one area of the implementation of capital that could help the economy very much, is retail and pension. So in Europe now there is a push to, and in the US, by the way, there is a push to open the alternative markets, the more structured markets for retail investments. And how exactly that will play out remains to be seen, but that would certainly be another aspect of innovation, be it ETF, be it mutual funds, private credit, in collaboration with public credit or public market. So these are the dimensions which are going to be developed, which gives me confidence that we're going to have available capital for more investments. Whether the product will be available and in what format, that again remains to be seen and depends to a large degree from the regulatory framework. And in that regard, I want to emphasize that we are seeing material deviations across regions. So I think we are probably going to end up with fragmentation of the regulatory framework. And in securitization, that's fairly easy to see. Just compare Japan, Australia, EU, UK, and US, and you'll see material discrepancy in the regulatory framework. That in itself creates discrepancy and fragmentation in the investor base. So very simple example. If I'm a EU-based investor, I may not be able to buy many Australian products, securitization, if they don't provide the adequate disclosure as required by the European regulatory framework. If I were in the UK, I can probably buy more of that. If I were based in Singapore, I can probably buy all of them. In the US, the same. So this kind of dynamics are leading to fragmentation of the capital markets, also leading to fragmentation of the investor base, and potentially would lead to fragmentation of liquidity and again, interest and demand. So how that is going to evolve and which products will be acceptable in one part of the world, not acceptable in other, how the money will move around the world remains to be seen. There is certainly capital there. There is certainly focus on diversification globally, both by currency and by product. There is certainly focus on yield and getting the best return on risk. And in that regard, Australia stands very strong, very attractive. And I generally hope that remains to be the case, at least in the foreseeable future.
Well, thank you. I mean, we like the market here, so that's great to hear that. It seems like there's a lot of changes coming our way. Markets are always throwing changes at you, and what you do to respond to them and to foreshadow them and foresee them is always the determining factor. But with you to guide us through this, it's an exciting time. So thank you again for stopping in and seeing us at the Australian Securitisation on your trip here to Australia and New Zealand.
Thank you. Glad to be able to share